good afternoon to all of you, and welcome to the webinar. This is our last webinar of the year, and it's great. We've been running these webinars throughout 2024, and it's been a really useful tool, I think, for both our existing investors as well as our new clients for them to understand what it is we do, what it's like to invest into the UK, what are the tools available to you to do so. And one of those the big questions that people often have is can I get a mortgage in the UK if I'm not from the UK, if I'm based in Turkey, as an example? And so it's great to be able to do these webinars to illustrate the process, a bit about the UK market, but also be joined by Sophia Kazmi, who we've worked with for many years, who is a director of the Madewell Group and a mortgage expert. And we like to make these webinars specific to individuals in specific locations, because inevitably there are some intricacies of investing in the UK dependent on where you are based, what passport you hold, and so we want to make it relevant to you, and that's why we are doing this webinar specific for our clients that are based in Turkey, both existing clients who have invested with us already, as well as obviously new potential clients that are joining. So I hope you find it useful, and obviously there's a Q&A box at the bottom here. So I'm going to go through a few slides, as is Sophia, but please do ask any questions that you might have in the box, and we will endeavour to answer them at the end of the webinar. So yeah, so do type away. We're going to start with a little bit of an understanding about who we are, Joseph Mews, who the business is, and then we're going to, as I said, come on to Sophia, and then we'll look at a couple of the products. But to take us back to our beginnings, we were founded by the gentleman that you see on your screen there, Andy Foote, who founded the company in 2001 based on his own experience of investing in property. He had a pretty bad experience. There was no customer service. He was kind of left to his own devices. And he wanted to change that. He wanted to say, look, if you're based in Turkey, if you're based in the Middle East, Far East, wherever you are, or even if you are based in the UK, that there should be a sort of mechanism whereby your hand is held through legal process, through mortgage, through renting, through furniture, all of those different things. And that's how we started. We ended up working as the distribution arm for a huge developer in the UK called Seven Capital. And more recently, we've changed name to Joseph Mews, based on the fact that we now work not only with one developer, but we work with various, which I'll come on to. So we have more realm within our portfolio to offer different options for our clients. Should we go to the next slide, please? We often get asked where our name comes from, Joseph Mews. A Mews house is a type of building in the UK, and our head office, which is in the UK, is a Mews house. It's called Joseph Mews, and it's actually named after the son of Andy, who tragically passed away from a brain tumor aged just 9 years old. And so this is Andy's swan song. It's his last business, and we wanted to sort of pay legacy both to Andy as well as to Joseph by naming the business after him. So Andy's been a successful guy in the real estate world, but he'll always tell you his greatest achievement was the brain tumor charity, which is founded by him, and it is now the largest brain tumor charity in the world, and has helped many lives all across the world. So we're obviously huge advocates, and if you would like more information about the charity and how you can support, you know, obviously would be hugely grateful. Next slide, please. So in terms of numbers and what we've done, we've delivered 36, it's actually closer to 40 now, developments, 3,500 units that we've built in the UK. And from a residential perspective, that's just under £600 million worth of property. This is important. It shows that, you know, we've done this before, and that's I guess a really important part when you're looking to invest into real estate, is understanding that the people that you're dealing with have a track record, that they know what they're doing. And that's how we've learned how to be specific to our clients in Turkey. We have clients all across the world. We have an office in Dubai, we have an office in South Africa, we have an office in the Far East, but we're obviously headquartered in the UK. That's where all of our developments are. Everything that we build and our headquarters, the back end of everything, is all UK based, but we have offices overseas to facilitate investment from clients all around the world. So that is you know, it's important to recognize that out of these 3,500 units that we've sold, 50% of those have been in the UK and 50% have been overseas, from our overseas markets. Next slide, please. So as I mentioned, Joseph Mews is the way that we work as a business. We work exclusively with developers. So this is an important difference between us and dealing with an agent. When you deal with an agent, there is no culpability for that development. You know, if something goes wrong, reputationally, you might be damaged, but there's no skin in the game as an agent. You have no financial burden if something goes wrong. With us, it's the opposite. So we partner exclusively with the developers, which mean that the only way that you can invest in them is through us. But in turn, we commit. So we pay for all the distribution, we name the buildings, we do the appraisals, we decide what we're going to build, the amenities, we do everything. And so obviously we're financially committed to these developments. So all of our due diligence is kind of our biggest strength, having a track record and knowing what our investors want, knowing what's going to work, and we only deal with the best. So some of these developers are they're all in their own rights, fantastic accredited developers in the UK. Knight Frank is a name that I'm sure lots of you know. We're partners with Knight Frank, which obviously says a lot about us as a business, being able to partner with what is probably the most respected PLC in the UK. And we get great opportunities through them as well. So that is an important point. We're not an agent. That is how we position ourselves. We are financially as well as reputationally committed to every development that we take on. Next slide, please. So as I mentioned, look, buying a property can be a pretty tedious process, particularly if you're living overseas, and particularly if you don't know who to speak to for different parts of the investment journey. So you have your legal obligation. You need a lawyer that represents you, that helps you through the process, is working on your behalf. You need a mortgage broker if you're taking a mortgage. You need a rental agent who's going to find you a tenant and manage it and collect the rent and all of that. And you need the after sale service, and we provide all of that. So obviously through partnerships, obviously Sophia is an example of that from a mortgage perspective. She's worked with us for many years and dealt with clients in Turkey and all across the world investing into the UK. We have a panel of lawyers that we introduce to you to help you through that. We have agents in everywhere that we build that will help you rent and manage the property. So all of it is coordinated by Joseph Mews. We are your point of contact, and we will help you through every single step. So you're never left to your own devices. And this goes on beyond completion. Once the property is complete, you still deal with Joseph Mews. You're not left on your own. We constantly do yearly reviews with you, obviously teaching you how to scale and build a portfolio. It's not just about buying a property, it's about maximizing the returns from that and turning it into a portfolio. So as I say, you're always dealing with us through every step of the way and beyond completion. Next slide, please. As I said before, Q&A box at the bottom, so please pop your questions in there and we'll answer some of them at the end. Next slide, please. So we've got a poll question here. It should pop up on your screen, hopefully, if we're not failed by technology. But the poll question is, what is your primary objective for investing in UK property? Is it building capital appreciation? Is it generating passive income? Is it creating a long-term investment portfolio? Is it immediate returns? Obviously, you can have more than one answer, but it's interesting to know what the sort of main intention is for you when you're looking to invest in UK property. So if you can choose that. Okay, that should come up. Right, so the majority of you have put generating passive income through rental income. And second, we have immediate returns. And then, so yeah, look, it's interesting. Everyone has their different ideas for why they want to invest. As an investor myself, I own a couple of properties in the UK. And for me, it is about generating passive income, and it's about legacy planning. It's about my future. It's about retirement planning. It's about generational wealth. And obviously taking a mortgage is a way for you to do that. I'm having somebody else facilitate my debt. My tenant is paying off my mortgage, my rental every month. And that's what's, going to enable me to achieve those goals in the future. What I would say is obviously immediate returns. The UK is probably not the market for that. This is a mid to long term strategy when you're looking at property investment, particularly in the UK. The beauty of the UK market is how it's performed historically over a period of time. And that's what you want to maximize. And so immediate returns, if we look at it from a context of immediate rental, then yeah. But in terms of the real value of this, it's about having an asset in a globally strong currency that's always going to be relatively strong on a global perspective. That is a tangible asset that you do have an exit strategy with, and it's going to be worth a lot more in the future. So yeah, all of them are good answers. But as I say, yeah, generating passive income is a common preference. Right. Next slide, please. So let's look at the current UK market. Obviously, it's ever changing, but it's important to look back to look forward, right? The reason that the UK is the most invested market in the world for overseas investors, which it is more than the US, more than Canada, more than Germany, more than Dubai, more than anywhere. It's number one. And the reason it is because of what you see on your screen. Wealth advisors, wealth managers will always say, have UK property as a part of your portfolio for this reason, because it's resilient. If we look at how it's performed over this period of time, what we see is that every 12 to 15 years, property prices double in the UK. And let's look at an example. If we go back to the recession, the recession of '08, if you had bought in the peak of '08, your friends, your family, your colleagues would have said, oh no, you've made a big mistake here. Property prices are going to crash. And they did. They went down. But if you'd held on to that property, today it's worth nearly double what you would have paid for it. And that's going through, the biggest economic crash that we've seen in our generation. So it's testament to the UK market that as long as you can hold on to it, you know that over time, the property price is going to double. And that's why it's such an attractive market, because you have that kind of security and it's based on fundamentals. The fundamentals being that the UK is a small island, not enough houses, and a growing population. We have a huge housing crisis in the UK that is getting worse and worse. It's compounding each year. So what does that mean? It's simple supply and demand economics. It means that you constantly have a tenant wanting to rent your property because there aren't enough of them. So you never have void periods. You're always getting your return every month. And it means that inevitably, with a lack of supply and a big demand, that you get prices going up in that direction. And so it's an important graph. This, it shows the resilience of the market. It is the most resilient market that you can find based on those fundamentals as well. So that's why we talk about this as a mid to long term strategy, because of what you can enable yourself to achieve. Next slide, please. Now the poll question: what is your biggest fear when it comes to investing in UK property? So if we get this to come up now, so the options are potential changes in government regulations and taxes, interest rates affecting mortgage affordability, difficulty finding suitable tenants and managing voids, unexpected maintenance costs and repairs. So let's see what we get here. Inevitably, there's always fears when you're parting with your hard-earned money, and you want to make sure you're making the right decisions. And inevitably, there are factors that will always affect that. And with property, these are the main ones. So it's interesting to see what the results are here. Okay. Potential changes in government regulations and taxes, interest rates are the main ones. Sophia will talk to us a little bit more about interest rates, which has obviously been topical in the UK in the last couple of years. And then obviously, again, topical has been the government regulations and taxes. We obviously saw stamp duty going up by 2% in the last budget. To be honest, we thought it could have been quite a lot worse. I think in the grand scheme of things, it's a one-off cost. Our property prices are quite low as well, so 2% isn't, a huge hindrance. But inevitably, if you're holding property for 15 years, you're going to see different governments come into power. You're going to see changes, but it's about the bigger picture. It's about looking at this in the grand scheme of things. And it's the same with interest rates. We have interest rates as an example. My mortgage interest rate went from 2.5% to 8.5% last year when interest rates went up. My mortgage is still being paid by my tenant though, because my yield also went up. And now it's coming back down again. And now we're going closer to the, 4.5%, 5%, which, as I said, in the grand scheme of things, to where it's been historically to other markets, it's actually still relatively low. And again, you're going to take the rough with the smooth. It will come down, it will go up over that period of time. But that's why you want to invest in areas where you get a high yield, that you're going to be able to pay off your mortgage, even with a higher interest rate from the rent of your property. And that's what we'll come on to shortly. Next slide, please. So we talked about the UK government and the shortage of property in the UK. This is a real problem that the UK has. The 1.5 million new homes across England is what the government is targeting. We're told by the end of next year, we're going to have 600,000 home shortage in the UK. 600,000, over 500,000 homes. And that's what boosts the market. As I said, it's why we have such a big demand for rental property. It's why we have a big demand for people purchasing property. And it's why that's attractive from an investment point of view. If we look at where we're going in the next 5 years, we look at the reports from Savills. Knight Frank, JLL, all the big PLC consultancies, they're really bullish. They're really bullish about the next few years based on this, and it's exciting. We've had a lot to deal with over the last few years in the UK market. It's still kept climbing, even through Brexit, COVID, wars, inflation, everything. It's still kept climbing. And now we're in a position where interest rates are coming down. The base rate obviously is coming down in the UK. And that's going to see a lot more purchasing power in the UK. So we're in a healthy position at the moment. Next slide, please. So based on that, this is from the BBC saying that average home now has 25 tenants wanting to view, which is crazy. So you put your property on the market to rent, you have 25 people wanting to view it. And that's why these void periods, they just are relatively unheard of. I've never had a void period of more than a couple of days in my properties because there is that big demand, and it's getting worse and worse. And from a renter's perspective or a landlord perspective, it's getting better and better because you just have that consistent demand. Next slide, please. Again, the press, that have been our worst enemy in many regards, being told that housing market's going to crash, which it obviously never did, quite the opposite. And now finally we're seeing some positive news. Looking at Goldman Sachs saying that they think interest rates are going to come down to 2.75% by next autumn. We're at 4.75% now. Obviously, that's come down twice, which is great. And it's obviously heading in the right direction. Again, house prices expected to leap more than £60,000. There's positive news. And when we compare it to other asset classes, we see Goldman Sachs is forecasting that the S&P 500, the annual return is going to be just 3% they're predicting over the next 10 years, which is down from 13% over the last 10 years. And so, look, we never would recommend to anybody to put all of their eggs in one basket and just invest in UK property. Absolutely not. But it is also good to compare with other investment classes and asset classes. And this is, an exciting time for property versus those others. So, it's good to have that positivity around the market again. Next slide, please. Again, this is the current market overview of where we are now. House prices have increased 2.4% year on year, forecast 20% in average over the next 5 years. Obviously, different locations have sort of higher and lower, forecasts, and that's what we'll talk about shortly. Rents are rising based on that undersupply, 8.9% year on year. It's very high. So you know that income is going to gradually increase through the ownership of your property, which means that ability for you to pay your mortgage off through your rent gets better and better, and that cash flow gets more and more positive. So we're not building enough. It's at all-time low, only 120,000 homes that we've built in the last year, and we need to build 340. So we're nowhere near, which is why this is an ongoing compounding problem that will go on for 50 years. So yeah, as I say, it's positive in many respects with regards to the market overview. Next slide, please. Stamp duty we mentioned. We're looking at the budget updates from the 31st of October. Stamp duty has gone up 2%. So that is another additional 2% that you will pay on completion. It's a one-off cost. You only pay it once. Every country has it. I'm not sure what the equivalent is in Turkey, but there will be one. It is a tax that we have in Dubai, we have in the UK, Germany, Canada, all over the world. But it is a one-off, and that has changed. So it will be approximately 7%. We can obviously do all the workings out relative to the property that you're looking at. That was one change. But the great news is that there was no change to capital gains tax, nothing there. So it's remaining at 18% for basic rate and 28% for higher, and unchanged. The unchanged capital gain, as it says here, reduces the risk of a surge in property sales. So that's good news. Next slide, please. So we're now going to come on to financing your UK property investment from Turkey. As I said, this is a really key part to your investment. It's one thing that I've noticed over the years that people aren't aware of, that they can take mortgages without a British passport, without living in the UK, with no ties to the UK. And so it's great to obviously have Sophia, who's guided us and our clients through mortgages for the last few years. And we're going to hear from her now, who's going to talk to us about what it is you need to look out for and what your options are. So over to you.
Thank you, Johnny, and thank you everyone for joining us this afternoon. So as Johnny has touched on, we've looked at the UK market and had an outlook on that. We're now just going to start exploring what mortgage options are available to yourselves as Turkish residents and potentially Turkish passport holders as well. And then we'll go into a bit more about the options in terms of investment properties that we have showcasing this afternoon. So if we could just jump onto the next slide, please. So we're going to start off with a poll question. So you should have the multiple choice pop up to your screen in a second, but what do you think is the biggest challenge in getting a mortgage as a Turkish investor? If you could please select one of the 4 options you see on your screen. So it's a lack of credit history in the UK, opening a UK bank account, limited lender options, or complicated application process. Okay, super. And it's an interesting one, this one, because this seems to be the most common response we get across the board whenever we do these webinars, wherever, all across all jurisdictions. The most common response tends to be lack of credit history in the UK. And it's a really nice one because the simple answer, and we'll go into a bit more detail in a bit later on, but the simple answer is you don't need to have a UK credit history nor a UK credit footprint at all. You don't need to even step foot in the UK throughout the whole process, even following completion. That all can be done for you. So there's no requirement to have a UK footprint, and we'll go into a bit more detail on that on the next slide as to why and how banks can work around that. Open a UK bank account. Well, some lenders do require you to have a UK bank account. If that is the case, we can arrange it for you, and we always recommend doing that early in advance, even if the property isn't completing for 1 or 2 years. Let's open that UK bank account and have it ready. It also means that if you want to send money over to the UK in advance of the property completing and starting the application, you have that account ready. Not all banks require you to have a UK bank account. So if you do prefer to use your local account in Turkey to service the mortgage repayments, or if you want to use an account internationally in the US or anywhere else, let's say, you can do so. Not all banks require you to have a UK bank account. Complicated application process. Certainly, I think, and lenders are constantly changing their criteria. So with that, I think that the huge benefit is having us help you and hold your hand throughout the whole process from application all the way through to completion, and then the teams beyond that as well to manage the property just ensures that that application process isn't as complicated as it could be. We manage that for you so that you don't have to, and we will liaise with the banks and everyone involved on your behalf so that you don't need to worry about that and have that stress. If we jump onto the next slide, please. So a few more frequently asked questions that we get, starting off with the first one, is what are the common challenges Turkish clients face, particularly during the mortgage application process, and how can these be addressed? So we've touched on them. I think being prepared is the main things that I would say. Often we have clients who will come to starting the process and they haven't had a conversation with us or haven't had a conversation to understand what their mortgage options might look like. What are the costs associated? What is the best way to structure that purchase? Speak to a tax advisor, speak to someone and have a look at how best to structure the purchase and overall what it's going to look like for you. Also having that conversation with us, even if it's 2 years in advance, we can give you a list of what documents that you need to start collating, what you need to prepare, whether you need to get your accounts audited potentially if you're self-employed as an example, or pointing you in the right direction if you need to get your documents notarized by a local notary public as an example. By having that information ready and being aware of what you need to start preparing 2 years in advance just means that that application process isn't going to be as complicated when we come to starting it. You're aware of what you need to start collating, and those challenges can be avoided quite easily. Can I get a mortgage in the UK if I don't have a UK credit history? Well, yes, absolutely. So to go into a bit more detail about what I mentioned earlier, as I mentioned, not all banks require you to have a UK credit footprint. In fact, most of them don't require you to. Some banks may ask to see a credit report from where you reside locally. So we might need a Turkish credit report. However, that's not always the case. You can, we specialize in clients who are based all across the globe, who often don't have any tie to the UK, and this is their first investment and step into the UK. And there are lenders that have an appetite to lend to you, and potentially, as you'll see when we go into some case studies, potentially even up to 75 and sometimes 80% loan to value. So there are certainly lenders out there that have an appetite, and there's no need to worry about not having a footprint at all. What happens at the end of a mortgage term? So we'll go into some detail about what we mean by this and how this, how this is affected. But in the UK, you have two different types of mortgage repayment strategies. You have interest-only mortgages and you have capital payment mortgages. On an interest-only mortgage, you need to find a way to repay the lender back at the end of the mortgage term. And that can be done through three main ways, really. One is remortgaging, and that's when you negotiate new terms with a more competitive lender in the market every 2 to 5 years, typically, with interest rates, as Jolly mentioned, predicted to continue to go down over the next couple of years. A lot of our clients are looking for shorter fixed rate periods or sometimes variable rate mortgages with a view to remortgage. At that point, you pay off your current lender, and then the new lender takes over the mortgage. So that's one way of what can happen at the end of the mortgage term. Secondly is sale of the property. So you can sell the property, repay back the lender, and then move your investments onto the next. Or of course, the final one is just sale of other assets in the background or paying it off through cash savings that you have. Those are the three main ways to, repay a mortgage at the end of the term. And finally, what are the benefits of speaking to a mortgage broker? I think, as we touched on at the beginning, it's having an understanding as to A, are you eligible for a mortgage? And B, what is that going to look like? What is it going to look like from a loan to value perspective? So what deposit do you need to have ready, and when do you need to have it ready by? What's the interest rate going to look like? What are your monthly repayments going to look like? And overall, what is the mortgage going to look like? And how is this investment going to work for you? We'll then give you an indicative term sheet, and that will then work really lovely into a cash flow that the Joseph Mews team will then put together for you, which overall shows you what the mortgage is going to, well, how much is everything going to cost on a monthly basis? What is your monthly net projection? And how is that investment going to work for you over a 5, 10, and 15-year horizon? So it's a really beautiful model that works really nicely and gives you a very clear and concise understanding as to how is this investment going to work. Having that conversation with us also ensures, as we mentioned, you know what documents you need to prepare for. We can start that account opening, so have your UK account open, ready if you need to make payments in advance into the UK. So having that conversation at the outset is extremely beneficial, and we recommend doing that for anyone whatever stage you are in the process. Next slide, please. So going into just a bit more detail about the benefits of a mortgage. So we often have clients who come to us and either aren't aware that they can get a mortgage, as you've seen from the questions, aren't aware that they can get a mortgage as an overseas buyer, as a first-time buyer without a footprint in the UK. And also some clients prefer to purchase in cash before understanding the benefits of a mortgage, and particularly from leveraging. So this is quite a useful model to demonstrate how one can take advantage of leveraging and growing a property portfolio. So if you look at the first line, we've based this on a simple example of a purchase price of £200,000. Now, assuming one purchases a property in cash for that value and you hold on to it for 10 years, let's say that property is then sold for £300,000 10 years later. Your investment 10 years prior would have been £200,000, which is the cash that you had put down, which means that you've made a profit of £100,000, which is the equivalent of a 50% profit. Now, if we use that same example with that same property, had that borrower put down just a £50,000 deposit and borrowed the remaining £150,000 from the lender, your profit 10 years later would have then been £100,000 on an investment of just £50,000. So your profit remains the same. However, as a percentage, that's now a 200% profit based on the deposit that you had put down 10 years ago. And where you really see the benefit of this is then when you then look at leveraging and growing that property portfolio. So if we look at the next slide, you'll see that with that initial £200,000 that you would have put into one property, you can spread that across 4 different properties and growing a portfolio in the UK, all generating you a rental income, a passive rental income, which will look after the mortgage on a monthly basis. And all 10 years later, you can then sell for £300,000 each. So you've benefited from the rental yield that you've generated, that obviously has also increased year on year. And then you have the capital appreciation from each of those properties. 10 years later, you sold each of those properties for £300,000. Your investment was £200,000, as same as in the first example, if you bought it in cash. Your profit, however, is £400,000, which equates to a 200% profit. And that's how, if you've heard the term before, landlords in the UK then become portfolio landlords. They leverage off those properties. The equity that's grown in them, you can also then look to release that in capital raise. So let's say the property goes up to £300,000, that additional £100,000 that's grown in the property, you don't have to sell it. You can look at capital raising, releasing that, and then reinvesting it, and then growing a portfolio, having 4, 6, 8 properties, all looking after themselves from the rent that they're all generating. So it's a really beautiful model. And if we go on to the next slide, a better way to even structure it is then looking at an interest-only mortgage. So the UK offers 2 different types of mortgage repayment strategies: a capital payment mortgage and an interest-only. A capital payment mortgage, firstly, is probably one that many of you are familiar with. It's a mortgage whereby, let's assume you take a 25-year mortgage term. Every month you're paying down part of the loan amount and the interest. So at the end of that mortgage term, the 25 years, your mortgage is fully repaid and you don't owe anything more to the lender. Alternatively, in the UK, we have what's known as an interest-only facility, which is quite niche to a handful of countries around the world. And it's a really beautiful model that works, particularly if it's a buy-to-let property and it's an investment property. An interest-only mortgage is quite simply where you're just paying the interest amount on the loan. So you're not reducing the capital loan, you're not reducing the loan amount as such, you're just paying the interest on every month. That means that the monthly mortgage repayments are going to quite comfortably be covered by the rent that you're achieving from the property. It also then means, as a result, from a cash flow perspective, you're far more liquid because your monthly payments are going to be significantly lower than they would be on a capital payment mortgage. And that then enables you, as we looked at in the previous example, to then grow your property portfolio so much quicker. You have that extra liquidity, you can then invest that into other properties and grow your portfolio. At the end of the mortgage term, as we looked at initially, you have to, of course, look at how are you going to repay that lender the amount that you borrowed initially, because, of course, you've only been paying the interest. And that can be done, as we mentioned, from remortgaging, selling the property, or, of course, paying it off from other assets or savings that you have. So it's a really, really great model. It's what most investors go to, and it's normally what we recommend for our clients who are looking at buy-to-let properties, but it's what 75–80% of our clients go for when buying a buy-to-let property. Next slide, please. So we've looked at the different types of mortgage structures. Now if we look at the different types of rates available. So the 2 most common are fixed rate mortgages and variable rate mortgages. A fixed rate mortgage is quite simply a mortgage which is fixed for a period of time, normally 2 or 5 years. It's completely up to you, depending on your appetite for risk, if you were. You can decide on how long you want to fix a rate for. Most borrowers at the moment, most of the clients that we have are going for shorter fixed rate periods, and that's to echo what Johnny said earlier. Interest rates are expected to continue to go down over the next 12–24 month period. So with that in mind, you don't really want to take a rate which is fixed for, let's say, 5 years. It's probably better to go for a rate which is fixed for 1 or 2 years, with a view to then remortgage when rates have gone down next year onto a more competitive and cheaper rate. Subsequently, your monthly mortgage repayments will then go down. Alternatively, you can go for a variable rate mortgage, and that means that your rate will then be reflective of the market. So as the Bank of England base rate goes down, your monthly mortgage repayments will go down as a result, because your interest rate would have gone down too. And again, that's a beautiful model and a beautiful tool that a lot of borrowers are taking at this time, because interest rates are predicted to continue to reduce. The other benefit of variable rate mortgages is that often they come with lower early redemption penalties, if any, which means if you want to repay the mortgage early, you can do so, and normally there are less penalties to do so with a variable rate mortgage as opposed to a fixed rate mortgage. Next slide, please. So we've put together an example cash flow of a Turkish client of ours who was looking at purchasing, well, they purchased a property in the Cornwall development that we completed on earlier in the year. And this was a unit in Birmingham. So this was based on a 2-bedroom apartment at a purchase price of £378,950. Now, this client, bear in mind, as a Turkish passport holder, you do have options to go to 75% loan to value. So, but this client in particular only wanted to go for 60%. So they put down the remaining 40% as a deposit. They opted for an interest-only mortgage as it was an investment property. So the loan amount equated to £227,370, which is the equivalent of roughly 10.1 lira, 10.1 million lira, sorry. Now, the interest rate that this borrower selected in particular was a 1-year fixed rate. As we mentioned, the aim was we're going to fix it for 1 year, and in the summer next year, we're going to look to remortgage, at which point rates are going to look lower. We can then look to remortgage, and potentially we'll look at a longer fixed rate period. We may then look to fix it for perhaps 2 years or 5 years, depending on what rates are available. So we fixed it for 1 year for the time being until the summer, and that's at a rate of 5.99%. That's on a 25-year mortgage term, and that equates to the monthly mortgage repayments being £1,134. You can see that we've converted everything based on today's rate to Turkish lira, just for ease of reference for you all. Now, the rent on the property is £1,579 a month, which equates to £18,948 per annum, which is equivalent of a 6% yield. And bear in mind, this is expected to go up year on year. Now, if we take off the monthly service charges and the letting and management fees that you can see details there, this client is left with a net monthly income of £155 a month. And that equates to £1,860 per annum. So the benefit is we've got the rent coming in, which is looking after the mortgage quite comfortably. The client is also left with the surplus income, which is going to increase year on year as that rent goes up from £1,579. But also, not only have we got that passive income looking and the rent coming in every month, we've also got the beauty of the capital appreciation in for that property, and where Birmingham is expected to grow over the next 5-10 years. So at that point, we can then look to also refinance and potentially capital raise, take out some of the money that's in that property, and again, reinvest that and grow their portfolio. Just jump onto the next slide, please. Perfect. And just finally looking at a checklist. Now, this is a very brief checklist, but it hopefully summarizes in a little bit of detail what documents you would need to start collating, or what information we would need at the outset when we come to exploring your mortgage options. So one of the first things is, of course, probably the most important, is identification, proof of ID and proof of address for where you reside. So in Turkey, as an example. Of course, those will both need to be valid. If certified, they will need to be certified within the last 3 months. We would also need the details on the property, but we can attain that from Johnny and the team, and that's to ascertain how much is the property going to rent for and what's the purchase price. Those are the 2 most important figures when it comes to calculating how much you can borrow, because of course, if you're buying a buy-to-let property, how much you can borrow is dependent on how much the property is going to rent for, and that's a really important figure which the banks use to then be able to confirm the loan to values and the loan amount which will be approved. That then leads us on to our next point, which is the deposit requirements. So as we mentioned, we'll look at the loan to values, we'll look at how much deposit do you need to put down. Typically, we say minimum 25%. As you saw, the other example was for a client who wanted 60%, but that was by choice. There are options to go for higher should you wish to do so. Yeah. Financial strength, so we'll look at your credit report, income statements, pay slips, and so on. So we'll inform you or let you know what documents you need to start collating. If you're employed, typically it's 3 to 6 months pay slips. If you're self-employed, sometimes banks may require audited accounts for your business. If you don't have those, but it's possible to arrange those, then perhaps depending on the lender that we suggest going to or recommend, it might be worth starting to collate those. If you don't have those and you're not able to, then we'll approach lenders who don't require that, and we'll lean on just the rent on the property. So there are both options we can look at. Opening a UK bank account, as we mentioned, if we need a UK bank account and you want to open one, we can do so. And then finally, legal and regulatory compliance. So Johnny will be able to introduce you to a highly recommended tax advisor that we work with, and it's just having a chat with him if you need to understand how best to structure the purchase. Do you want to buy it in a company? Do you want to buy it in your personal name? Have a look at all the other costs associated so that you are aware of what you need to prepare for and how much you need to have ready by the point of completion as well. So it's a really useful tool to have that conversation with us and to have that conversation with the professionals and the qualified advisors in their respective areas, so you know, and you're just well prepared when it comes to starting the process. As I mentioned, this is a very brief checklist, but we'd be delighted to have a conversation one-on-one and to give you a very detailed list of what you would need to start collating specific for yourselves. Next slide, please. Thank you. So I'm just going to now pass back over to Johnny, who's going to talk about choosing the right location for you and your investment property. Thank you.
Perfect. Thank you very much, Sophia. And look, what we'd always encourage is if you do want to understand what your specific kind of requirements or situation is, then you can book in a free consultation with Sophia and her team, and they'll be glad to guide you through that. And what they can do is provide you with those indicative terms, as she says, to say, right, these are your options. You can get a 70% mortgage and this is the rate. So then you know where you stand and you know what your affordability is. So it's well worth doing if you are exploring those options. We're now going to talk about choosing the right location. Obviously, this is super important. When you're making a decision is where should I buy? And that's part of our job at Joseph Mews, is to understand, right, what are the areas that we should be building in? And what do we look for? Well, we look for transport links changing. We look for what are the future developments in that area? What are the jobs that are coming into that area? What are the institutions doing? And where is the demand? We know that there's high demand across the UK because of the undersupply, but obviously there's areas where that's greater than others. So these are the kind of things that we look at when we make our decisions to build. And obviously you should look at when you make your decision to invest. Go to the next slide, please. So when we look across the UK, we talked about there being a sort of generic 20% projection over the next 5 years. In certain areas, it's higher than others, and so every consultancy has a either more optimistic or pessimistic view on this. But if we look and take the average, then we look at areas like Birmingham. Birmingham 5-year prediction is really strong. The average rental yield is strong. And then we look at places like Leeds, where the yield is higher because the average property price is lower. These are the kind of facts and figures that we look at when we make our decisions. And as I said, what we want to achieve and what you want to achieve, particularly when taking a mortgage, is that ability that you can pay off your mortgage by the rental. And the only way that you can do that is by having a strong enough rental yield, which is your return, percentage return month on month to achieve that. When we look at lower rental yields locations, that model doesn't work. And for that reason, if we go to the next slide, London doesn't really fit the bill for that. London is an amazing city and it's a fantastic investment in many respects, and people have done incredibly well from there. But because the prices have got so high and the rentals haven't managed to catch up with that, your average rental yield is 3.82. And as you get closer to the center, that's a lot lower. It's about 2%, which means that every month you're not going to pay off your mortgage from the rental because it doesn't compensate for it. So that's why we look in these second and third tier cities, where not only do you get a higher return and have positive cash flow with a mortgage, but also the projection for growth and the ability for capital appreciation is also higher. Next slide, please. Again, this illustrates what we just talked about: low capital values and higher rental yields. If we look at London, bottom right, it is very much the other side of the spectrum: high average property price and a low average rental yield. So these are the areas: Leeds, Birmingham, your Manchester's, Derby. These are the areas that we focus on, and you should as well, to achieve what you want to achieve. Next slide, please. So again, looking at where the market is performing best and where it's predicted to, Yorkshire, which is the county where Leeds sits, and Sheffield and Bradford, that's projected to perform better than anywhere in the UK really over the next 5 years by many sources. And so that is an area that we are committed to ourselves, which we'll come on to shortly if we go to the next slide. So we're going to look at the actual opportunities, and what I would suggest is look, we have various developments and we have different developments that are completed. We have some developments that are off plan, whereby you're only putting down a deposit now and it's not completing for another 12 months. And so there are various different locations, various price points. And so if you would like more information, then please do ask and we'll send them over to you. But I'm going to show you the kind of property that we are building with a couple of our newer launches. And again, we've got a few that we're going to answer at the bottom already. But if you do have more questions, please remember to put them in the box at the bottom. Um, so this is a development that is only 24 minutes from the centre of Leeds. It is a beautiful development in the countryside in just outside of Leeds. And again, when we build, we look at what the market demands, right? And there's been a big shift in the UK in recent years for the obvious reason with COVID, the working culture changed. People in the UK are working from home a lot more than they used to. We're told that 44% of the population last year was working from home at least 2 days a week. And in the higher price salary earners, that goes up to as much as 80% of people that are working from home. And so inevitably with that shift in working culture comes a shift in the demand for property. People want more space. They want amenities. They want almost a community within that development because they're spending more time at home working there. And a lot of people that are renting apartments, the younger demographic in particular, don't want to just sit at your kitchen table to work. They want to have a workspace there where they can go and feel some separation from where they work and where they live. So this is what we take into consideration. It also means that, look, you're always going to have a demand for city centre because some people want that hustle and bustle, but you do have a demand from people that don't want to be in a city centre and want to be in the countryside where they feel safer, freer. You have the ability to go out for nice walks and have that lifestyle element. And so this is what fits perfectly with the house in. It's only 24 minutes. 24 minutes is nothing as a commute into the center of Leeds where all the jobs are, but you have the benefit of what you see on your screen. It's surrounded by the Yorkshire Dales. It's got a stream running through it. It is a beautiful, beautiful development. And if we go to the next slide, you'll see here, this is where it's located. So it's 24 minutes on a direct train into the center of Leeds. And at the station is where you have Deloitte, PwC, Channel 4's headquarters. All of these big companies are positioned at the station. So your commute is less than 30 minutes door to door, but you're getting the benefit of living in a beautiful countryside development. If we go to the next slide. As we talked about amenities, I mean, there is nothing on the market that has them quite to the extent that the Halcyon does. It not only has the workspaces that we talked about, it has a gym, it has a yoga studio, a Peloton gym, it has guest suites. So you can actually, if you have a one-bedroom apartment, but someone comes to stay, your mum comes to visit, you actually have rooms upstairs in the development where they can sleep rather than sleeping on the sofa. It has a cinema room. It has a golf simulator. It has serviced offices, breakout lounges. It's incredible. And as we saw from the previous slides, starting prices are about £160,000. And you're putting down a 20% deposit prior to completion. So looking at about £35,000 to buy something of this incredible quality in the best performing market in the UK. So it's a really beautiful site, this. We go to the next slide. This is what we talked about earlier. This is from the ONS, the Office of National Statistics. It shows us that when you go to £40,000 and above, those numbers of people working from home are 60% and even up to 80%, which encourages this kind of property that doesn't exist at this price point. So that's why it's so exciting and why it's so fitting for what the market is demanding right now. Next slide, please. So Bingley, the area that this site is located, was actually voted the #1 destination for commuting into Leeds. So it's the most desirable place. And you'll see why. It's a beautiful, beautiful old British town surrounded by Yorkshire Dales, beautiful scenery with lots of nice outdoor walks and activities that you can do there, but still less than 30 minutes direct into the centre of Leeds. So it's a great and well-recognised location. Next slide, please. The big thing as well, we talked about sizes. People are spending more time, so they want bigger spaces. The average size of a one-bedroom apartment in the UK is 490 square feet. The average size of a one-bedroom apartment at the Halcyon is 750 square feet. Bigger apartments, again, in line with where the demand is coming from nowadays. Next slide, please. So this is an overview. It overlooks a cricket field. And again, it's just surrounded by beautiful countryside with a stream running through it. So it really is a beautiful spot to have a development. These are the breakout areas. You have a barbecue area outside. If we keep going through these slides, you'll see these are the sort of spec of the apartments that we build. Floor to ceiling glass with beautiful views over the countryside. Again, in the bedroom. Keep going. And then we'll come on to the amenities. There's your 36-seater cinema room. You have this huge, beautiful atrium where you can sit and have a coffee or work or entertain. And then you've got a games room with a pool table, table tennis. You've got these working spaces, offices, private dining areas. You've got all of these incredible amenities on site within your home, which is just a huge benefit to have. Gym with a cardio room, weights room, has their own changing rooms, and then you've got your concierge there. So it's an amazing spot. And this is the overview, surrounded by greenery opposite the cricket field. All of that is being redone and landscaped. So it's going to be a really beautiful, peaceful, tranquil location that, again, is in a really lovely town of Bingley, which is beautiful. So yeah, we love this development. We know it's going to do well from a rental perspective and have huge demand because there really is nothing like it on the market. We use agents, as I mentioned before, to do appraisals on these sites. So Martin and Co are one of the biggest agents in the UK, and we get them to go to the site and they do an appraisal. So they say, right, this is what we can rent these properties for, and they've looked at the prices and the sizes and everything for this development, and they've given it an average gross projected yield of 7%, which is very high for the UK. And that's fantastic news. So these will be the guys that actually rent the property for you. So they're putting their name to it, and those are the ones we will introduce you to, as well as others that can actually rent the property for you. So they're very excited by it for obvious reasons, looking at the site. Next slide, please. Another one that we've got with the same developer, if we keep going through, this is a smaller development, lower price, starting from only 124,950. This is completing slightly sooner, so it completes at the end of next year. It's a beautiful Victorian building, 37 units. And yeah, it's a restoration essentially. So it's got a huge amount of character. It's a beautiful, beautiful development. If we keep going through, Wakefield is just 13 minutes from Leeds. So it's actually on the train up from London. Wakefield is one of the stops, and then the next stop is Leeds. So it's one stop on the train, only 13 minutes. And Wakefield itself is actually a city, a cathedral city. It's got a beautiful cathedral in the center, and you have jobs, amenities, and everything. So it's a different concept to Bingley. Bingley is countryside, beautiful living. This, you're more in the hustle and bustle, and you're only 13 minutes to Leeds. So if we go to the next slide. This is the development. Again, it's beautiful Victorian listed building and making these beautiful 37 units. They're doing it on a Mayfair boutique style is what they want to build. So you'll see the quality is going to be absolutely beautiful of this development. It's also got a gym and it's also got a co-working space. Not the same level of amenity as the Halcyon, but still you've got your gym and you've got your co-working space, and there's only 37 units, as I said. The developer that are building these two are called the Secon Group. They're massive. They're the biggest developer in Yorkshire now. They've built over 1,000 units already, 267 commercial developments. They're well recognized. They're doctors, they're MBEs, and they're trusted from a recognition point of view. They actually go down and advise on the housing crisis and shortages in Parliament, and so they're a great partner of ours. We work exclusively with them. The only way you can invest with the Secon Group is via Joseph Mews, so it's a wonderful partnership to have. Next slide, please. Then we've also got a slightly different project in Ascot. So many of you might know Ascot for the horse racing. So this development is literally opposite the racetrack. So you can see from there, these are all computer images of the housing. But if you look to the north, the top of your picture, you can see the racetrack there. It is the closest development to Ascot that exists. So inevitably, this is perfect for short-term rentals. It's perfect for rentals. It's a beautiful area, one of the most affluent areas in the country. Obviously, with that comes higher prices. These are starting from £400,000. Average rental yield is lower because of that. Completion, there's different phases. The first phase completes Q3 of next year, so not long. And there's others that complete later. It's only a 10% deposit though, so deposit starting from £40,000. But yeah, this is being done by the biggest developer, or second biggest developer in the UK, Taylor Wimpey. It's recognized with JLL. They're the consultant. So it's a very due diligent project here. And as I said, it's in one of the best locations you can have in the UK, surrounded by great schools, beautiful scenery. Obviously, the racetrack being great from an investment perspective, 20 minutes from Heathrow, and less than an hour into the centre of London. Next slide, please. And this is the showroom. So again, big developer, great track record, and beautiful quality, what they have consistently built. So you can really trust this developer and this development as you can with the other two as well. And that's the sort of promise that we make to our clients on the developers that we work with. As I said, we've got other developments in Birmingham, Manchester, Bracknell, all over the place. Completed, not completed. We've got a real mix. So if you do want more, then information, sorry, then please do let us know. Conscious of time, obviously, we were not going to go through all of them now. But yeah, that is. There are many other options, and if you do want something that is ready, we even have developments that are actually tenanted and returning straight away, as well as the off-plan model that we've just been through. Next slide, please. So that brings us to a close, and again, conscious of time, we're nearly at an hour. So thank you so much for joining and staying on and listening. I'd like to bring Sophia back on, and we'll just do a couple of questions again. I know obviously that you know we've been on for over an hour now, or nearly an hour. We've got a couple of questions, and inevitably a few of them are around mortgages. So obviously great to have Sophia back on here now. We'll start with one of them, Sophia. Client is asking, I own a limited company in the UK. What are the pros and cons of the company owning the property rather than the person owning it? I mean, I can answer it in some regards. From a mortgage perspective, what would you say?
From a mortgage perspective, there are options to both. Sometimes with mortgages, you might find that the interest rate might be a little bit more expensive, or the bank arrangement fees might be a little bit more expensive. But otherwise, there are lending options for both the company or personal name. But this might be one more best suited, Johnny, for a tax advisor who can go into the benefits of why structure it and, you know, why purchase in a company. Yeah, I mean, sometimes depending on your passport and where you're resident, it might make sense to, you know, in the UK, you have a tax-free income allowance of £12,570 per annum. So sometimes it might make sense to purchase it in your personal name, which is what the tax advisor might advise if you're purchasing up to 3 properties, typically, to be able to take advantage of that tax-free income allowance in the UK. So it really just depends on what your plan is, I think, whether you're looking at growing and building quite a few properties, in which case maybe an SPV might make the most sense.
Yeah, look, from a tax perspective, as I say, we're not tax advisors. We do work with a tax partner, so we can introduce you to them if you would like. I think just one thing to mention from buying through a company versus buying in your own name is Turkey has a double taxation agreement with the UK. What that means is that if you are Turkish and you live in Turkey, that you benefit from a tax-free allowance, and that is of £12,570 income per year. So if you don't have any other income in the UK, your first £12,500 is free income. So you pay 0% tax. If your spouse or partner is on the contract and they also have a Turkish passport or British passport, then you get that agreement as well. So that makes it £25,000. So that means zero tax. So that's a big benefit. If you were buying through a company, then obviously you pay corporation tax. So when you buy through a company, you pay corporation tax, which is 19%. So if you already had income in the UK and you're in a higher tax bracket, then inevitably it makes sense to do it in a limited company because you're paying 19% rather than a higher bracket. If you don't have any income in the UK and you're buying 1 or 2 properties at these values with these returns, then it makes sense to do it in your own name to make sure that you get the benefit of that double taxation agreement. So, but again, we're not tax advisors, but if you'd like some further info, we can certainly introduce you. Are you operating only in the UK? Yeah, look, our developments are only in the UK now. That's where we position ourselves, and that's where all of our partnerships are. So yeah, in different locations. Had a couple of questions. Do you only focus on Leeds? No. As mentioned, we've shown Ascot. We actually have Birmingham. We have Manchester. We have various different locations. So if you would like more info on those, then please do ask, and we'll send them over. Do you need to come to the UK for any steps? And does owning property ease in long-term visa? So you don't need to go to the UK for any of the steps. You are more than welcome to go and see the sites. We can arrange that very easily, but you don't need to. From a mortgage perspective, you can do it from wherever you're based. From a legal perspective, everything's done over Zoom, electronic signatures, anything you can courier, you courier. So you do not have to be in the UK to do it. In terms of visas, it can help owning a property and having a bank account there from a visa perspective. You don't get any citizenship or anything like that in the UK like you do in other parts of the world from investing. In the UK, you'd need to spend £2 million for that to be a possibility. But from a visa perspective, we are told that it does help by owning that property, but it's not a guarantee. What type of assets should we should have to apply for a mortgage? For instance, let's say we have large land in Turkey. Can we apply for a mortgage in the UK? Sophia, one for you.
Yeah, I mean, so having the land in Turkey though doesn't, as we mentioned before, you don't need to have a UK footprint, nor do you need to necessarily have any property anywhere else globally. This can be your first purchase across the globe. So having the land, we can certainly mention to the lender, maybe if that land is generating an income, if you're renting it out, then perhaps it's worth noting. But otherwise, no, there's no requirement to necessarily have that land, or it doesn't have any bearing necessarily on the mortgage. Again, on assets, the bank will take a security against the property in the UK. That is the asset that they take a security against. So again, having assets overseas, the bank will be able to take a security against that, and so there's no need to worry about that.
Okay, perfect. Thank you. And obviously, look, if you do have assets in the UK that you have the opportunity to release equity from those to purchase property as well, which is another conversation. Can I use a mortgage for a property I plan to purchase in my child's name? I guess not.
It depends on how old they are, well, and how you want to structure it. I mean, maybe there's a way to perhaps, and it'd be worth speaking to an advisor on it, how best to purchase it, but maybe do it in a company and have your child on there as a joint owner with yourself. Depends on how old they are. Typically, if they're going to be under 18, we're going to struggle to get them on as applicants. So it might be best to maybe put it in a company, or maybe buy the property and then later on gift it to them.
Yeah, you do have the opportunity to gift properties to children or whoever. So that is an option. And as Sophia says, the benefit of the company structure is that you're shareholders of the property together, basically. So you can put 5 names on there. But yeah, again, it will depend how old the child is for the ownership. During the mortgage period, who owns the property? You own the property. So for once you exchange contracts, when you pay the deposit, you legally own that property. So there's no ownership by the bank or anyone else. You are the full owner of the property, and you have every right to do whatever you want with it. Live in it, rent it, sell it, do whatever. So yeah, you're full owner.
Yeah, and that will be legally detailed as well on HM Land Registry. So that will be legally your property publicly available as well. And there are legal documents to demonstrate that.
Yeah, exactly. Are there any legal restrictions if we want to evaluate the property via Airbnb as a non-resident? That's a good question. So previously in the UK, most leases on developments said that you couldn't do that, that you weren't able to rent properties short term. And that was the case for a long time. That has changed with a lot of developers now. So give you examples of what we're doing now. Those 2 sites that you saw, the Halcyon and the Point around Leeds, they are both fully allowed for short-term lets. The Ascot property is allowed for short-term lets because that's going to be its biggest market. You're literally opposite a racetrack where there's meets pretty much every weekend. There's concerts. It's going to be amazing. We've done an appraisal there from a short-term let angle, which is over 7.5%. So they're allowed for short-term lets. The Birmingham ones are as well. Pretty much all of our developments now are allowing for short-term lets. So it's a good question. It's always good to check with the developer that you buy with. But with ours, they are, I'm trying to think, I think all of them that we're selling now are all allowed for short-term lets. So you have that opportunity. The obviously good thing about that is a lot of clients say, oh, maybe I'll use the development for a couple of weeks a year. Obviously, that gives you the flexibility. And again, on the short term lets, we help with that. So we would introduce you to the partner that is going to rent them for short term. We do the same for long term, short term. So again, we will organize that for you. Will you share a copy of the presentation? Yes, we will. We will send you an email after this and send anything over that you would like. And also, you're going to have the opportunity now to click whether you'd like to book in a meeting with either Sophia for a mortgage, or you'd like to book in a meeting with myself or one of the sales team from a property market and option perspective. So I think with that, over an hour, we will bring it to a close. But thank you very much, everybody, for joining. We will be in Turkey next year as well. We're going to travel over in Q1, so it would be great to meet as many of you as possible. So if you'd like more information on that, then please do ask. Just actually, Sophia, a last question that was just
No.
come up now. Sanjana, maybe if you put up the box if people want to book the meeting so they can do that before they leave. But somebody's asked, I'm retired with no source of income except some bank accounts, interest, and and own some property. Do I qualify for a mortgage?
Yeah, in short, yes. You don't necessarily need, as we mentioned earlier, you don't need to necessarily have any income. We can just lean purely on the rent that the property is going to generate. So yeah, we can certainly look to obtain a mortgage or potentially even still 70% loan to value, maybe a little bit higher. But yeah, that's certainly an option we can explore for you.
Perfect. Yeah, a lot of people aren't aware of that as well. So as I said, look, book in a meeting. If we bring up the next box, I think you're going to have, yeah, oh, it's come up already. So you have a screen there if you want to click. Obviously, you can do more than one, speak to both Sophia and then to myself. So if you just click one of those, then we'll be in touch. But all of you will receive some information. And as I said, if you want more info on email, we can also send that over. But again, Sophia, thank you so much for your time yet again. Last one of the year. And yeah, wishing you all happy holidays and thanks again.
Absolutely. Thank you everyone for joining us this afternoon.